You'll see Wally has a more complicated first name, but apparently Wally is a nickname which we're all allowed to use because it's simpler. And Eric, we discussed what we were going to be talking about today in terms of the title of this panel. Stablecoins in business, revolutionizing corporate treasury payments and trade in Africa. And this is a very, very wide subject. And as you've already noticed, the panel's length is quite short. So we wrote down, I don't know, how many questions did we write down here, guys? 22 questions. There's absolutely no way we're getting through 22 questions, so I'm going to stick to the big ones. Short CV. Eric is General Manager Africa for Conduit. Now, is that correct? Conduit? Yeah. Okay, it started in Boston, I believe, but it's a multinational and it runs out of multiple countries at this point. Is that right? And they are in the business of cross-border payments, crypto being fuel for that particular industry, and I'm going to allow him to talk about that with a greater degree of articulateness than I'm doing it. Wally is Chief Product Officer at Mansa, also multi-country cross-border. There's a slightly, also cross-border payment and settlement. There's a slightly different flavor of that has to do with the liquidity pool, and at the right point I'm going to be asking you to describe what you do. But let's start off with some of the strategic and big picture questions. The issue of cross-border payments, as everybody knows, has been hobbled, would be the most polite way to say it, by the impossible and incompatible regulations between countries. I mean, you've got SWIFT, but there's all sorts of other things that comes into play, and so you have delays, and so it's difficult and onerous and painful and error-prone and blah, 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 to get money from one country to another, either on a business level or on a retail level. Stablecoins arrive with a perfect solution to this. You turn your money into stablecoin, and you just send it to a wallet on the other side so that you can settle it. But why is this suddenly acceptable now? Isn't it being blocked? And I want to start off with you. And when I'm saying blocked, I don't mean only blocked by the regulator, I mean blocked by the people whose power is taken away by a stablecoin payment. So let me start with you, Wally.
So if you kind of look at some of, the reasons why stablecoins are blocked depends really on it's contextual. If you kind of look at Nigeria, if you look at Kenya, and those countries that are very far away even from trying to regulate the usage of stablecoins, you find, there's a host of reasons. Like if you kind of look at Kenya, previously, it was just a political thing where they were trying to work through the whole process of regulating, like discovering what it is and regulating it. There are certain countries, like for example, if you look at Nigeria, for example, the slowdown is simply because of the power of the banks. And that's the reason why you see, even in other technologies like mobile money, the banks really say that it's us who's supposed to do it. But in Kenya, it was, mobile money was licensed differently from the banks. They allowed mobile money to thrive. So contextually, you have to figure out to see that the reasons why stablecoin is either advanced or crypto is advanced and or slowed down depends on the particular intricacies of that particular location.
Yeah.
Yeah, there are countries that just, it's not a priority. Like if you kind of go to Uganda, it's not a priority. You cannot see any momentum of movement when it comes to regulating it.
Right.
Yeah.
Are you finding the same experience? I know that you operate in similar countries on your side, Eric, that you're getting blocked. There was a discussion I had with somebody earlier in the room over there, is that the banks generally didn't want to talk about crypto at all for the longest time. There was a level of employee at a bank who was at senior management level or even junior management level, tremendous pent-up demand, tremendous interest, tremendous enthusiasm. When you get to the executive board level, nobody wanted to touch it. Now there's a feeling of nobody wants to get left behind. Is that your experience?
Absolutely. And so I can possibly start a bit, speaking a bit about the Conduit experience. So when we started off, we were offering a yield product to fintechs, institutional investors in the US that wanted to maintain a bit of exposure to the crypto space. But that was going on greatly up until FTX and the whole mess with USD happened. But then when we pivoted towards the B2B cross-border payment space, particularly came from need. So you had these interesting crypto-native companies, exchanges, apps out of Africa, out of Latin America, coming to us looking to on and off ramp with us. But then the thing that we tended to learn is increasingly it became very, very difficult to offer. You could offer great on and off ramps, but you have to offer extension. A stablecoin is of no need to a business if they can't make the final payout towards it. And so it was a major block, and it was one of the big challenges that we had to face, particularly, someone mentioned this in the previous US administration. It was something that we experienced. Now, coming down to Africa, same conversations, our early conversations with the banks saw a lot of doors getting shut at us. People wondering, are you crazy? Why would I try to look at this? But then here's the thing about innovation. If it's solving pain, then it's a moving train. You either jump on or get crushed by it. And stablecoins are solving real, actual pain. We are seeing it every single day. Businesses, small merchants, larger businesses, etc., opting to use stablecoins for that movement of value, and I think it's an exciting time to be in the space for sure.
Yeah, and just to add, also there are certain regulating things like crypto and stablecoins. You need to have sort of like infrastructure that already exists that you can leverage. For example, if you look at Kenya, we already had CBK, we already had CMA, and we had already formalized how mobile money is used, and you find that a lot of transactions are already online. So then it's easier to just leapfrog from there to actually, what's the next evolution of this? Yeah. But if you go to countries where they literally don't even have a mobile money licensing structure, they have no way in which you can be able to send money digitally. You see, they are very far behind that. Licensing virtual assets and so on and so forth is really not a priority, because they are still yet to figure out how can they be able to move money, particularly on the retail space, easily.
Yeah. So there's quite an interesting trajectory in stablecoins. If you go back to 2017, when the first stablecoin was invented by Rune Christensen, it was called DAI, it was called the DAI. And it was invented so that crypto traders who wanted to swap between Ethereum and Bitcoin and any of the other ones could have a place to park their money while they were making their decisions and wouldn't have to go back to fiat. There was a second use case that happened outside of the crypto native industry, which was when people in non-American countries who were scared of inflation in their own currencies or debasement in their own currencies, which was many, realized that if they parked their money in stable coins, they got richer. This happened in Nigeria to a spectacular. I read one statistic that 30% of salary earners were putting their money directly into stablecoins, just leaving them there while the Naira dropped. And when they finally took them out to buy produce, they were richer than they were before. Then suddenly this thing appears where stablecoin enters the institutional world. So the next question is, there are a bunch of use cases in the corporate institutional world, business world, which would include intergroup cash pools, supplier payments, trade settlements. And so I wanted to ask you where the major use cases you're seeing in business for stablecoin. Let's start with Eric.
Great. So I know you mentioned quite a couple of them, and I tend to go back to history. If you have to think about how money and trade and commerce moves in Africa, and to me that's the most primal of the use cases that stablecoins have been able to solve on the continent, right? So the way economic activities are set up on the continent is more from an extractive perspective. Processing happens elsewhere. We can discuss the mechanics of that till death and never come to a resolution. Now, banking infrastructure or the money movement infrastructure took the same pathway, but then this antiquated way of moving money in the 21st century needs an upgrade. And so to me, when I come down to the question that you broadly asked, trade makes the most sense. commerce in Africa and in a lot of emerging markets is essentially built on correspondent banking infrastructure. If I am a South African trader or a South African manufacturer sending goods to a supplier in Kenya and I need to get paid, the funds have to leave London and New York via the correspondent banking infrastructure. Great cities, but there's no reason why funds should be sitting in those markets. And then before getting transferred, and then you have a mirror of the FX transactions between the two accounts. Now, cost, time that it takes to get to do that is just prohibitive. Now, what makes stablecoins great from my perspective is the collapsing of those payment layers, the correspondent banking infrastructure, the FX conversion, the settlement layers as well. And what would typically take sometimes T+1, we've seen T+5 transaction is settling in a couple of minutes. And that way you can do two great things: build greater velocity of money that I, as a South African trader, trading with this Kenyan, I can do a lot more with my funding and my money if I need to get paid. And number two is eliminates a lot of hoops, counterparty risk, for instance. If these transactions are all happening on-chain, then incidentally, it's very, very easy to build immutability. I can tell where my funds are at. One of the greatest challenges that we tend to solve as a company internally is we still have to rely on traditional banking infrastructure for the money movement, whatever they call the stablecoin sandwich. So the fiat on-ramp, the stablecoin transfer, the fiat off-ramp. But then on the on-ramp, our customers, who are primarily fintechs, will consistently call and ask, how have my funds landed? How have my funds landed? But then when the funds land, let's assume into a virtual account or into a bank account, then they can essentially have a great trail and a great proof of how this value is able to go. So long-winded answer is I think stablecoins are going to dramatically shift how trade happens in emerging markets, and I do expect that to be particularly magnificent on the African continent.
Do you have some comments about that?
Yeah, I mean, I would like just to reinforce that from our experience at Mansa. So what Mansa does is that we provide on-chain liquidity. So if you look at most of the African countries, we are like net importers. So you'd find that there is a business that imports cars from Japan. And when the clients for those businesses want to import these cars, they basically have to pay the importer. They have to pay the importer in local fiat, which takes a long time to settle. So such companies would come to us, and we would be able to give them short-term liquidity to cover their obligations before they actually are in receipt of the local fiat that they've been paid. And then they would be able to send these to Japan. They would be able to convert to yen, send to Japan, China, whatever they're importing on behalf of their customers. So all that, as you can see, is trade finance. And we are able to free working capital. We are also able to bring down the fulfillment period for these businesses to their customers down to a couple of days from what would take 7 to 14 days. So I think the biggest impact is trade finance, particularly trade finance that is happening between Africa and in more advanced markets where it's very easy to get OTC desks and so on and so forth. But within Africa, I think it's kind of a little bit hard, and we have not seen cases of customers who come and take up our liquidity product and they're processing payments or trade payments between, say, Kenya and Uganda. What we see is, say, Kenya, a company that is processing payments between Kenya, China, between Ghana, and Japan, and so on and so forth.
Yeah. So I just want to hover on two things that were said there for a moment. The first one is this concept of the liquidity pool. It was when I started doing this stuff a long time ago in crypto, it was not clear to me what an absolutely critical component of the whole crypto ecosystem is this thing called a liquidity pool that sits in the middle. And the liquidity pool, which is basically a pile of money which is in the custody of a market maker, makes the two people doing either a trade or transaction, that guarantee is held by the liquidity pool rather than by the two players on either side. So the transaction speeds up if there's a liquidity pool. The other one is the issue of time, which you mentioned. If you take away all the advantages of stablecoin, forget about the fact that it's secure, forget about the fact that it's not volatile, forget about the fact that it's global, and you just choose one thing. which is the reduction of time to do a transaction or a payment. That reduction of time, in the language of global finance, is called the velocity of money. And if you just take the velocity of money, I saw a statistic, and I'm sorry I can't remember the exact statistic. If you simply increase the velocity of money by 2 times through a nation, you get an increase of GDP by 2 times. Now, the increase of the velocity of money via a stable coin compared to fiat is about 100x. And so there are governments now waking up to the fact that forget about all of the other advantages of crypto. If I can speed up money moving through my economy by 100 times, there is a massive increase in the GDP of the country. Okay. I want to talk about risks and failure modes. So Eric, where are the risks in this business? We all know about the risks of buying cryptocurrencies and watching them go up and down with volatility. That doesn't exist in the world of stablecoins. So what risks do you see on your side?
Yeah, couple of them. So I think the major one that I keep hearing from regulators whenever we visit them is they are worried about their reserves. It's a major it's a real worry. But the way that I think about it is we do not need blanket bans, and I think the easiest way to do this is embrace it. And I'll say this because of 2 elements. One, the other great thing around the money movement in stablecoins or on-chain pretty much is this concept that Felix also mentioned called the on-chain FX element. And so if I am any African government right now, and I would be slowly thinking and actively thinking about how to enable innovators to start issuing local stablecoins. Already, we've seen very, very early elements of it happening. A couple of years back, there was a currency swap that took place between Nigeria and Ethiopia. So Ethiopia Airlines, one of the largest airlines on the continent, Dangote Industries, giant manufacturer of cement in Ethiopia, both of them are sitting on currencies that they don't need. Dangote does not need the Ethiopian birr in there. Ethiopian Airlines does not need Naira sitting in Nigeria, and a currency swap was able to happen that. But then, I mean, we're speaking about one of the largest companies, 2 of the largest companies on the continent. So what does that mean for Eric looking to trade with Steven? So if there is a possibility for that movement of value on-chain between 2 locally issued stablecoins, then that's a major advantage. Coming back a step back again, on the other major risk that I'm also seeing is there's still a lot of lack of understanding of the space. If you speak to a regular user, they still trust their bank, and possibly it's a legacy issue of whatever is associated with issuing tokens and with the crypto space. And so I think that fear and market education is still a risk. It's still one of the challenges that is plaguing the industry. And finally, I would still say stablecoins still can't operate in isolation. We still have to rely on traditional financial infrastructure in whichever shape or form that looks like, whether it's on the off-ramp, whether it's on the on-ramp, whether it's in the transfer of value. And so that in itself is something you can control. If the banks don't want to work with you, that's it. You don't want to. They don't work with you. If it doesn't hit their risk matrix, it doesn't hit it's within the risk matrix. And so that's also another major blocker and a major risk that I'm seeing a lot of, and it's something that indeed we do face as an organization as well.
Yeah, I think he has mentioned a couple of which I wanted to bring out, but the other one that I think it's closer to our business and also really applies to everybody is the stablecoin issuer risk, or basically the on-chain risk. The fact that you could have liquidity, but then you have, you have different chains, and then converting between chains, some chains and maybe they don't work, or you have cases where some wallets are hacked, or some MPC infrastructure that we rely on have liability and issues like that. So the issue that we try to really mitigate a lot is basically the stablecoin issuer and the on-chain risk. And then you also find that some of these stablecoins have depegging issues, right? So if we, like for example, if you look at Mansa, we issue our liquidity is denominated in USDT. If you look at our competitors like ARF, it's denominated in USDC. So we try to really base our liquidity on, and this is a major mitigation, to base our liquidity on stable coins that are actually pegged with cash and cash equivalents rather than any other synthetic instruments.
Yeah. So, which brings up an interesting question that was asked of me, which I really didn't have a good answer. I'm going to ask both of you to answer. I'll start with you, Eric. The question is, why have local stablecoins at all? I mean, everybody trusts USDC and USDT to the extent that they trust the dollar, which is, of course, a whole other question. But let's assume that the dollar is still the most trusted currency in the world. You can get there through through Tether, which is the largest, and through USDC, which is the second largest. Why have a local, like in South Africa, we have ISA and ZARP? Why just not use the dollar stablecoin at all time? What point does it have?
Amazing question. I think about it in the most basic of terms. If you walk into downtown Nairobi right now and you ask someone what value or what currency or what are you holding, it's likely going to be the Kenya shilling. And for us to have true usage and true adoption of stablecoins, I think you have to meet the people wherever they are. They're very, very comfortable with their local currencies. They are very, very comfortable with their local payment methods. And they're very, very comfortable, and it's widely accepted. That acceptability is already available. And so to me, that's a one critical element that makes the most sense. Indeed, it doesn't make sense then to hold local stablecoins if my currency is inflationary. But when you think about it, most transactions are still largely peer-to-peer. They're still largely within an economy. And so if we want to have that adoption, then stablecoins are likely going to be, local stablecoins are going to be great for those local transactions and those local payments. But then when you come to the cross-border payment layer, then that's where it becomes absolutely necessary to either look at the more stronger and the more less inflationary currencies. Now, coming back to my previous point, how do you ensure that there is a marriage between those local issued stablecoins and these globally recognized stablecoins, the USDT, USDCs of the world? And that's where the element of on-chain FX comes in, allowing for faster, cheaper, and honestly, abundance of exchange between, say, a locally issued stablecoin and a globally available one.
I think just to add on that, I would say, if you look at a stablecoin transaction, or any transaction for whatever the reason, it's only as fast as its last mile. So if I send you...
It's only as smart as its last mile.
Yeah, it's only as fast as its last mile. Only as fast as its last mile.
Yes.
So if, for example, I am sending stablecoin to a company in Kenya, and that company needs to pay its workers, okay? So I send it with stablecoins. I pay the company with stablecoins. They acknowledge the payment in seconds. But its workers, they cannot be able to use the stablecoin as it is. They actually need local fiat.
Yeah.
So for them to be able to do that, we have to do maybe a transaction on the local rails that probably will take 4, 5, 6 hours. Even settle the next day. If we kind of look at the RTGS system that we use in Kenya, if you do the transaction past 4 o'clock, it will be received the next day. So you have sent the money lightning fast between the two counterparties, maybe Mansa and the local company in Kenya, but it has taken 4, 5, 6 hours, and it takes away all the benefits of stablecoins. But if we had local stablecoins that is actually used by those workers, maybe to buy bread or whatever, then it means they could actually receive their money in seconds. So you see that the lack of local stablecoins and their adoption and use, it sort of wipes or dampens the true characteristics of stablecoins, which is instant finality and
it's a great answer. Even if everybody had a smartphone and only dealt in stable coins, the local guy still thinks of the price of bread in naira, not in dollars.
Exactly.
Yeah, okay,
exactly.
Got it. Guys, I want to give you each a chance to talk about your companies, because I'm not sure that your companies are that well known to this audience, which is Conduit and Mansa. Eric, I'm alternating here, doing a binary. Just a couple of minutes on what you guys do.
Yeah, thanks. At Conduit, we are a provider of B2B cross-border payment infrastructure. So we primarily work with fintechs and businesses in emerging markets, so Latin America, Africa, and recently Southeast Asia. And what we are very well known for is settlement. So we believe the customers and the businesses that we work with do a very, very good job of figuring out local currency conversions, but then we figure out the settlement. So we issue USD, Euro, GBP virtual accounts. We offer great conversions between stablecoins and these hard currencies and the inverse as well. And much more critically is we are licensed in the US as an MSB, have a license in Canada, working on a couple of them in Singapore and in Hong Kong. Overall, aggregate process about $1 billion every month of value, and that's growing. About a third of that is out of the African continent. Raised a bunch of venture funding, about $54 million. I know a couple of our competitors were mentioned previously, BVNK and Bridge, but if we're looking for very, very great institutional partner, great payment technology, and much more critically, solid regulatory and compliance rails, then we are the two go-to guys for any business and any fintech in EMs.
That was Eric in sales mode. Go ahead.
All right. So for Mansa, we provide on-chain liquidity to payment companies, particularly fintechs. Further, like stablecoin infrastructure companies, virtual card issuers, but mostly cross-border transfers. So our liquidity is denominated in USDT. We are actually backed by Tether. As you all know, USDT is sort of like very popular in the global south, and USDC is popular in the global north. Just to position what we actually do, our competitor in the global north is AF1. They provide the same things that we do. We provide liquidity to companies, but they do it in USDC. And they are sort of have a strong relationship with Circle. We have a strong relationship with Tether, and our focus is on emerging economies. So if you kind of look at it, is that if you are a company and you get paid in fiat, I like explaining what we do using an example. If you're a company and you get paid in fiat, fiat literally crawls to you, taking 3 days just to arrive in your bank accounts. But during that time, you have obligations that you need to fulfill. You would come to us. Previously, we would have onboarded you, and we would have given you a credit limit that is available to you to use at any time. So you tap on the credit, and any time we disburse it to you, all fully on-chain. And we also have light collateral. We do not basically hold your money or hold anything. We basically just govern our relationships with you using covenants and auditability, our ability to have a view on your receivables. And then you'll get this USDT, then you'll be able to kind of convert it to USD or any of the local currencies, settle your obligations, and in 2 to 3 days, maximum 1 week, once you have received your money, then you can be able to pay us, and then we make our money by charging a small interest on the finance that we have provided you. So it's a very, very simple business model. We have a lot of demand. We have almost up to, I think, 3 trillion in demand, because that's the value of cross-border trade that is happening in the global south. So we're growing really, really fast. I think we are probably one of the fastest growing fintechs. We launched last year, and we're already processing over $300 million in total payments volume. So, yeah, that's pretty much what we do.
Good, fantastic success story for Africa. I'm going to do a lightning round now, which I'm going to ask you for a one-word reply. Start with you, Wally. If you had to choose faster or safer, which would you choose?
Safer.
Faster.
Okay. Biggest misconception about stable coins?
Volatility.
Fraud.
Fraud. Okay. This isn't a one-word answer, but it's the last one of the lightning round. If the regulator calls you tomorrow and says you are completely free to do what you want without any interruption from us, what would you do first?
License fully crypto-native off-ramps and on-ramps, because I really think that's where the buck stops between the stablecoin world and the fiat world.
Right.
For me, local stablecoins. I think on-chain FX is going to dramatically change how the world operates, how money moves around. And I think, yeah, definitely local stablecoins everywhere.
Great. I'd like to open it up for questions.
It seems the panel was awesome. There are no questions. We have one.
Hi. Is there not an argument in some way to consider creating a stablecoin based on a basket of currencies, especially in Africa? So for international trade between different countries, you have this basket of currencies, and they're pegged against a certain stablecoin, and then instead of using the USD or USDC, you use the local African stablecoin.
Well, many conversations have been had about this. In particular, there is the initiative by the Afri-Exim Bank with PAPS. And one of the conversations is, why can PAPS essentially build this interesting token, I guess they'll call it a CPAPS or something, that essentially allows, that is one unified stablecoin that is usable across the entire continent. Here's the biggest challenge. One is you have to figure out, you need to have a fully collateralized stablecoin that makes sense, for it to make sense. Now, if you decide to pick a bucket of African currencies, and I know this was mentioned before, or African assets, they will have very, very different variations. Some currencies will be experiencing, will be the strongest they've ever been, others will be the weakest that they've ever been. And so if you have a bucket of these currencies and a couple of African country bonds, and then possibly gold and any other oil and any other minerals, then my challenge becomes that I don't know if I can trust that stablecoin to be fully pegged one-on-one to whatever this is going to be. The movement of the underlying assets, in my opinion, is way too volatile to have true, to be truly stable and to be truly pegged one-on-one. So I think that's the inherent danger that comes with it. And I think we've seen this experiment before, particularly with stablecoins, algorithmic stablecoins. So you have this stablecoin that is partly backed by actual government treasuries and bonds, etc., and then an element of it is maintained by code, and a part of it is backed by a couple of digital assets. Now, whenever the price of Ethereum behaves in a certain way, then you tend to find this stablecoin depegging, and the whole element of it being pegged one-on-one is trust. And the moment you lose trust by the average user or even by any major user, then it becomes a very, very difficult song to sell. However, I do think there are very, very firm believers that we will likely have that at one point. I don't see it happening, but just because of the nature of African governments as well. But anyway, well, it's to be seen. It's to be seen, but that's just my opinion.
I think mine is very short. It's just that we have to realize that stablecoin and blockchain technology is a medium, right? So the inherent issues that you'll have when you have this bucket of currencies, even without stablecoin, just as fiat, will still exist. The only difference is that the effects are accelerated. So if, for example, if you're talking about the Congolese or Chadian currency, the reason why you can't just transfer this between each other will still remain. It's just that, like, you can't abstract the fact that you have used stablecoins from the inherent issues of having a bucket of currencies that can be traded by a particular region. And that means currency devaluations, etc. It's just that they will be more pronounced or accelerated because now they can move faster or they are visible much, much faster. You know, it's just like writing a bad letter using email. It doesn't take away from it that it's a bad letter. You know, whether it's delivered by hand or it's just that you'll get the message faster because it's email, but it's still a bad letter.
I want to close off by asking the audience a question, which you can answer by raising your hand. You have to be absolutely truthful. How many of you have used a stablecoin in your private life or your business? Okay, 40%, not bad. Okay. Thank you very much. Thanks for your time, and thanks to my
Thank
panelists.
you.